Good afternoon from London, everyone, and welcome to this panel discussion convened by OMFIF and Fitch Ratings on emerging trends in banks' climate and environmental integration, where we'll explore the implications of COP26 for the financial sector commitments to net zero, the impacts of climate change on credit and liquidity risk, as well as the latest developments in central bank stress testing and scenario analysis tools. I'm Emma McGarthy, head of OMFIF Sustainable Policy Institute, and I'm joined today by Peter Cation, Chief Investment Officer and Global Head of Climate Finance at the IFC, Rick Lackile, Executive Vice President and Global Head of ESG State Street Corporation, David McNeil, Head of Climate Risk, Director of Fitch Ratings, and Gabor Gayura, who's Head of Sustainable Finance at Magnir Nemzeti Bank. Thank you all for joining me today. So I do encourage our audience to engage and ask questions, so please do insert your name and your question into the chat box, and I will bring this to the speakers. So let's dive into the panel discussion. And I think my first question will be, how should climate and environmental risk be integrated into the monitoring of the financial sector's business environments? And Peter, I'll go to you first. Welcome, thank you for joining us today.
Great, thank you very much, Emma, and a pleasure to be here. So maybe just a brief word on IFC and our climate finance business. Currently, we target to do 1/3 of our investment in climate finance. And we have a target that translates into about $9 billion a year, including mobilization. Specifically in the financial institutions group, which is where I sit, we do $3 billion of direct investment in financial institutions. And we have over 800 clients actively involved in emerging markets. So from a climate risk perspective, this is coming under the Paris alignment work. It's really become core to our day-to-day functioning and prioritization. So we've really looked at this from both a top-down and a bottom-up approach. From the bottom-up, it's working with our 800 clients to give them the tool assessment methodology. And then from a top-down approach, working with the regulators, along with the World Bank and the IMF, to set up the landscape and the policy framework to allow for development of more detailed climate risk assessment tools. So we basically look at it in 4 stages. First, with the financial institution, is really creating that awareness and understanding of what climate risk is and why it's important. Second is providing them with the tools. And we like to start with just a few specific asset classes. So if we give a loan for SMEs, let's first focus on developing the climate risk assessment tools for that specific asset class. The next stage, the third stage, is really taking a more strategic approach, excuse me, where you engage with the most senior level of management and the board to give them that overall understanding of why climate risk is so important, and also emphasizing the opportunity set, because risk is seen as a negative, but in fact, climate investment opportunity is absolutely enormous. So you can tap into that while at the same time mitigating some of the new risks that are coming on account of the climate change. And the fourth area where we focus is with the regulators. And I can talk a bit more about what we're seeing in emerging markets. Specifically where we want the banks to focus on is transition risk and physical risk. And under transition risk, to have that awareness that there's both an impact on the probability of default and the loss given default, given that stranded assets, of course, would have less residual and recovery value. So it's really important that the bank understand both and the overall impact on the expected loss in their portfolio. With regard to physical risk, we're focused on developing tools that allow for geomapping to show where their portfolios may be more vulnerable to actual physical risk. And this is particularly relevant for the agribusiness sector and for sectors such as tourism. So I could go on much further, but I want to give our esteemed panelists a chance to come in as well. Thank you.
Thank you, Peter. And maybe Gabor, I can turn to you. So welcome, lovely to have you here. How do you think climate and environmental risk should be integrated into the monitoring of financial sector's business? And maybe you could touch upon some of the key performance indicators that you think should be implemented as well.
Sure. So I'm from the Central Bank of Hungary. We are part of the NGFS, and also, of course, as part of the EU, we're also, let's say, implementing the EU's Sustainable Finance Action Plan as supervisors. And well, the Hungarian banking market is not a very well-developed banking market, so we are still an emerging market. And I can tell you that our banks are, I would say, still at the beginning of this long journey with the integrating climate and environmental risks. It's already, I think, a big question whether we are just talking about climate risks or also including environmental risks. In our case, at the Central Bank of Hungary, we always treat together with climate other kinds of environmental risks. But I can tell you that also as a supervisor and also the bank supervisor are much more developed with physical and transition risks, and for instance biodiversity or other environmental factors I think we are much less informed about all these factors. And actually in the EU the framework talks about ESG risks, so we might even add other aspects, but just staying with climate, I think we are still struggling to find the best KPIs also as a supervisor, and also our banks are working hard also to access data. And again, unsurprisingly, with large corporates, especially listed companies, it's much easier because, for instance, non-financial reporting is already something that large listed companies have been doing also in Hungary. When it comes to large companies, it's a little bit more difficult. So for instance, banks can reach out to these large customers with longer surveys, asking also qualitative and quantitative things. And when it comes to SMEs, then it's really difficult. So just to mention two things, of course, the carbon intensity of a sector, of an industry. And if we have the data, the borrower itself is always a good KPI. And looking forward, what we expect a lot from is basically the EU taxonomy, and there will be a brand new KPI for large companies and the EU. It's the alignment of a company with the EU taxonomy. So how much is the whole activity of a company is in line with the EU taxonomy, which will also include, of course, not just climate, but other environmental factors. And actually we expect a lot from this KPI, that this will be, hopefully, if data quality allows us, a very good KPI representing, let's say, how sustainable companies are. But that's just something in the future, in the coming years to come.
Thank you, Gabor. And maybe Rick, over to you for introductory remarks, and also how you think risk should be integrated, perhaps touching on key performance indicators, but also the due diligence and assessments that you think should be conducted before investment and its continuation as well.
Yeah, thanks very much for the opportunity. Well, I think every financial institution is different, and I think that it's important to remember that, because the questions about how you monitor and integrate into the financial sector. State Street's a custody bank and a very large asset manager, and so we've got experiences with how that might be done, but we're also shareholders in financial institutions, so we've got a perspective on what banks, insurers and others should be doing. On the how do you integrate it? I think two simple things, really, easier said than done maybe. One is use standardized frameworks. I mean, increasingly you don't need to invent your own yardstick. I think there can be incremental advantage to this, to inventing your own processes where such things don't exist at all. And it's still the case that, you know, areas like PCAF doesn't have a methodology for all conceivable instruments. So I think you have to do a little bit. But where they do exist, there's real value in using those standardized frameworks like the Greenhouse Gas Protocol, PCAF and others. And the reason for that is it makes it more effective and comparable across different financial institutions. It also makes it easier to mainstream it. So by mainstreaming, I guess I mean, rather than having a specialist department necessarily look at this, you put it into the wheelhouse of the organization, whatever organization happens to be, an asset manager or a custody bank or commercial or retail lending bank, that as part of their normal activity, they're using this data set and these standardized data to make an assessment. And it's not an act that's different from the things that they're doing in other respects. The other reason that standardized frameworks are very important in the financial sector is that we face a lot of demands from other stakeholders. So we want to do a good job ourselves, but also ensure that we're able to communicate that well. And obviously one of the roles of State Street as a custodian is helping its own clients to satisfy either regulatory requirements or those from other stakeholders. And that's made much easier if you can coalesce around a certain set of standardized frameworks. I think transparency in the financial sector is obviously increasingly a premium. How can we communicate with stakeholders that we understand and have integrated those risks is not more important than integrating it, but it is certainly essential to maintain confidence in the system against a background where many are concerned about risks that aren't being perhaps managed properly by the financial sector.
Great, thank you, Rick. And David, over to you for introductory remarks. And from Fitch Ratings perspective, how climate and environmental risk could be integrated, maybe some KPIs, and also how due diligence and assessment should be conducted as well.
Yeah, certainly. So thanks for the opportunity. Great to be here today. I guess from a ratings agency perspective, I mean, we can opine on KPIs per se, but we can signpost, areas where we think better disclosure might help understanding of credit impacts and where credit risk can materialize. So we've published quite a number of reports looking at the implications of central bank stress tests in particular for the financial sector. We published a report last week looking at bank climate stress tests and credit implications, and I'd encourage you to take a look at that. But generally, the kind of common theme that we seem to kind of encounter quite frequently, both within our research and within some of the webinars that we host and some of the engagements that we have with market participants, is challenges again around data. So what's already been cited. We had a webinar last November on the subject of bank climate stress tests, and our audience polling actually showed that around 2/3 of participants indicated that they felt climate stress tests to date had actually provided limited additional information because they felt that the data gaps were too large. So I think you can see in the context of the European Central Bank stress test in particular, there's really a strong emphasis on data quality and trying to improve transparency. So the ECB is conducting within it the focus of its stress test an assessment of data collection and management practices, so particularly looking for detail around emissions models that are used and around emissions factors that are applied and the underlying calculations that inform some of these assessments. So generally, I'd say it's probably fair to say the industry as a whole has fairly limited experience of handling climate data, and even less of translating that into credit, market, and liquidity risk. So generally, the steer that we see from a lot of regulators to banks in particular is it's better not to be overly reliant on one data source. Generally, most of the banks that are kind of trying to tackle this are making use of multiple data providers. But there are good examples out there of banks actually doing their own engagement work with counterparties and using this to augment third-party data. And one of the recommendations of the European Banking Authority was to develop common coefficients and proxies for modeling this type of data at the European level as a fallback for a calculation of green asset ratio reporting at the counterparty level. And I think this kind of feeds back to the general push for harmonization of climate data, for increasing access to that type of data, and an emphasis on open access data. So one of the examples of that in the European context has been the move towards an open access central data point for European environmental data and wider ESG data. On the real estate side of things, a push towards publicly accessible energy performance certificate databases for buildings, which again can be quite useful for banks that are conducting stress tests focusing on those sectors. And again, I think some of the findings from the initial stress test results are quite indicative in that we see quite a wide gap between disclosures from larger banks and then those smaller banks within the European Union that are less likely to have conducted a climate materiality assessment. They're less likely to see environmental and climate risks impacting on the risk profile over the next 3 to 5 years. But generally, in terms of credit and liquidity risk to date, we've seen very limited risk, some evidence of a degree of rising risk premium or restricted lending practices for certain fossil fuel activities. I'm thinking here particularly of thermal coal in the EMEA context. But generally, this takes the form of enhanced due diligence by banks rather than outright deal rejection. So lending activities tend to be limited to the highest risk companies within each sector. So there is kind of increasing focus on this, but quite a strong jurisdictional effect. We see substitution of financing quite common in regions with looser or tighter climate and ESG regulations, for example.
Brilliant, thank you, David. And yeah, indeed, stress testing is something that we will dive into a little bit more later, and we can also touch upon a bit more the issues that we have with data, and perhaps in particular forward-looking data, which you can use for projections with scenario analysis tools. But I want to go back to this point on credit and liquidity risk, and maybe Rick, I can turn to you on this. So, what impact are you seeing in terms of the climate change impact on credit and liquidity risk?
It will have an impact on both credit and liquidity risk. I think that's not, questionable. I think what is difficult is assessing whether it may already have been encompassed in the work done either by credit risk teams in banks, rating agencies, or elsewhere. It's a little bit difficult to prove it one way or the other, but I guess there is a growing awareness that that's important. And maybe it manifests itself most in those financial institutions that have got a fair amount of concentration risk. Because, for example, liquidity risk is associated with climate risk clearly has a concentration geographic dimension to it. In other words, that liquidity risk is much less profound if you've got sources of liquidity that are very widespread, and the lending side has clearly got risks that are very well diversified. But you can see that the opposite is the case. So again, back to this question about large versus small, concentrated versus diverse, I think they all play into this question of how you calibrate something that's got very unknown long-run effects, physical effects of climate change and transition risk, with the actual business results that power the risk that financial institutions give you. I think the thing, I guess at the moment, we're not necessarily worrying about double counting, we're possibly worrying about undercounting the risks, and that's appropriate for kind of prudential thinking. But I think it's important that we do keep it in perspective, that we don't have redlining that somehow starves certain industries or sectors or geographies inadvertently as well. That the credit system still prices credit appropriately for a wide range of uses. But I think we're beyond the nascent stage. I think people understand it, certainly conceptually understand it, but I think many risk professionals are used to having long histories of data on which to build models and frameworks. And this is a brilliant example of where it doesn't exist, and yet we still have risks from a forward-looking perspective that we need to deal with. That's a little bit uncomfortable, I think, for many who are used to being able to quantify things and calibrate models based on history.
Yeah, absolutely. Gabor, as our central banker in the room, do you have anything to add on that?
Yeah, sure. Well, as for liquidity risk, it's on our radar, but we haven't really been able to really capture this. What we are looking at, for instance, is basically one possible channel. It's through securities of like equities of bonds or of companies who might be, for instance, sensitive to climate policy changes, like and maybe downgrades because of climate policy changes, as an example how transition risks could result in liquidity liquidity impacts. It's rather, I think, of course, the credit risk, which is I think where we are more advanced, and I think where the interlinkages are probably more intuitive. Maybe let's just mention two sectors, just to give a flavor of about our thinking. Let's take, for instance, agriculture. It's very difficult. We have very, very granular data about agricultural loans, like loan level data. But of course, we don't really have data about the kind of practices these agricultural borrowers are following. And with agriculture, they are both exposed to physical risks and transition risks. And it's very difficult because you can be a extremely sustainably working agricultural borrower, but you could at the same time have a very huge physical risk as a borrower. So again, it's I think very difficult, and again this leads us back to this data problem. But again, if we can solve this thing, we will probably more better placed to understand impacts on PDs and LGDs. And to mention one more sector where I think we are more advanced, it's buildings, which David has already mentioned, and I can confirm that it's extremely useful to have access to EPC data and to combine then EPC data to loan data. And here, of course, again, we still haven't been able to arrive at very solid, let's say, links between the energy efficiency of buildings and the credit risk performance of mortgages, for instance. But we are working on this, just like many other researchers and central banks. And I think it's rather promising what we see. So I think, again, the intuition is, of course, that with energy efficient mortgages, of course, because of the collateral's better energy efficiency performance, there could be a good impact on both PD and LGD. This is still yet to be confirmed, but I think this is the area where both our banks and also I think other European banks and also we as supervisors are more advanced. And this is probably the sector where we will first get more tangible results about PD and LGD characteristics of energy efficient lending.
Yeah. Peter, do you have any perspective on this from an emerging markets viewpoint?
Sure. So yes, I mean, in emerging markets, it's still nascent in terms of developing their credit, climate risk, the methodologies, but it's actually a little more advanced than one may think. We about 10 years ago created the Sustainable Banking and Finance Network, which consists of 43 member countries, primarily central banks and also banking associations. And we recently did a report, the Global Progress Report on Sustainable Finance, to basically take a survey of these 43 markets and see where they are in terms of pillar 1, 2, and 3. So pillar 1 being ESG integration, pillar 2, climate risk management, and pillar 3, financing of sustainability. And I was actually pleasantly surprised to see the results in that it was a bit more, the people were further up the curve than we thought. So, for example, in pillar 1, the ESG integration, 75% of these countries had already had launched ESG frameworks. In terms of pillar 2 on the climate risk, 65% of the countries were formulating them, and a further 10% had quite developed methodologies in place. And for the third pillar, about half of the countries had a sustainable finance framework in place. And again, about 20% actually had formal taxonomies to cover green bonds and new types of climate bonds. So, EM is so important in this picture because it basically more than half of the GHG emissions come from emerging markets. And arguably, they will be most impacted by climate change because there's certainly greater vulnerability. So what we've done, really working in concert with the other development finance institutions, we have a working group consisting of 14 DFIs, and we've come up with a climate risk methodology in tools that we're disseminating throughout our DFI network, and then of course with our clients. And the focus of this has been on Paris alignment. So at the time of COP26, we basically all announced that we will become Paris aligned in the case of IFC, fully Paris aligned by 2025, and laying out the framework and the steps to reach that. So for us, this is really critical to work, as I said, from the ground up, and then from a more top-down level with the regulators. Specific programs that we're rolling out at the IFC is we've partnered with the Japanese government to have a TCFD reporting, including all the climate risk development frameworks put into place. And then we have some country-specific programs, for example, in South Africa, in Egypt, where we're working over 5 years to really develop the whole climate finance framework from climate risk to new investment opportunities. And this is a program supported by the German government. So we really try to take first a comprehensive approach, partner with other development finance institutions, because as a standalone, you can't really have the needed impact. And maybe I'll just refer back to a point made by Rick and David about the importance of standardization, and also leveraging what's already out there. Because nowhere is this more important than in emerging markets. I mean, frankly, we look to Europe and say, okay, what are the European central banks doing? What is the climate risk approach and methodology? Because there's no sense reinventing the wheel, and we're really using that knowledge, that IP, to translate it and transfer it to emerging markets. We've done that with green bonds going back 10 years, where we set up green bond taxonomies in multiple emerging markets. We've recently done it with blue bonds. With ICMA, we published a blue bond taxonomy and framework. So we're just going to follow the same approach with climate risk and really leverage what people have already done, and of course tailoring it to the local context environment as well. Thank you.
Thank you. David, Rick, do you have any response to that in terms of standardization and developments of green bonds and taxonomies, that kind of thing?
Yeah, I mean, I think the work of the International Sustainability Standards Boards could be pretty critical here in kind of aligning many of the kind of different regional and sectoral frameworks that we have out there, and multiple different standards for companies in particular to report against, which really presents a lot of challenges for comparability of data. I think we're slowly moving from a very fragmented data reporting landscape towards kind of coalescing around common standards at the global level, whether that's TCFD, whether it's ISSB. Some of the work of the IFRS Foundation, for example, in this space, I think could be really useful longer term.
Thank you.
If I can just, I mean, the power of labeling is vast, and I think the green bond trend has been a great success. I know there are those who would have concerns to some degree in green bond labeling and adherence to it, but overall it's been a great success. So the question is, what's next? I think the blue bonds are interesting. I think also the transition finance is a neglected area, because there are quite significant capital needs from corporations or other entities to get from A to B. And while they're in state A, they look pretty bad. So, you know, enticing people to finance them when their metrics and their optics would look terrible is quite challenging. So I think we do need to push the boundaries a little bit and say, we need to find good labels for things that are going to deliver sustainability, at the same time good financial returns, beyond the boundaries of those in green. So I think the power of labeling is significant. We should exploit it but not abuse it, and look for other things that would enhance sustainability.
Yeah, I'm just going into the point of labeling and some of the concerns that you mentioned. How do you think that those concerns have been mitigated? For example, that, you know, you're able to market your bond or your label in a particular way, but you're not actually doing what you say you're doing, and there isn't that level of accountability, and then it becomes the person who's managed to market themselves the best and stick that label on is the one who gets the capital. What are your thoughts on that? How that can be managed?
Well, if I may answer that question, I mean, I think that's a straightforward case of mis-selling. I mean, I think there's nothing special about green mis-selling. If you represent something and then do something else, that's a case for potential civil litigation or even criminal litigation. So but I do think it's serious, because you know, greenwashing is potentially a big problem, and we should look to the cures for that. But it doesn't mean that we need to be able to pin everything down to the nth degree. And this is kind of the challenge of labeling. You think, well, not everyone agrees. Do we need to pin down all the loose edges before we actually move ahead? You know, we could spend almost infinite time discussing things, and it flushes out many issues. You know, think about the European Union with nuclear and gas. It was a fascinating discussion. I think they got to a good point, but many would disagree with me on that, on, you know, how you classify something. So I think we need to, you know, the 80-20 rule, the 95-5 rule might apply. We need to make progress, and sometimes that means accepting some imperfections.
Yeah, no, I think that's a good point. We've had a couple of audience questions, so I'll go to those. First of all, from Pablo Valiero, who talks about the challenge of estimating the financial impact across the whole portfolio, especially kind of taking into account physical and transition risks, but most importantly, kind of how to look at the performance and initiatives across your supply chain. So do we have any thoughts on that in terms of kind of how to manage the initiatives, the performance of your supply chain? David, maybe I can go to you first on this.
Yeah, certainly. So I think, again, kind of standardization of data can be a real use for you here. We've got very limited disclosure still of scope 3 by many companies, particularly beyond the kind of large listed corporates and the SMEs. There's quite a lot of kind of climate risk in the supply chain that's still not monitored, not reported. So I think that is going to be a case in most cases for banks in particular of kind of modeling that exposure in counterparty supply chains. I think the more data disclosure that we get, the better we can model. So, the work that CDP does in that area on supply chain disclosure is certainly very helpful. But I think, we will see increasingly kind of banks using other technologies such as blockchain to kind of look at supply chain risks and try and improve disclosure and transparency. Because clearly, I mean, we have moved for scope 1 and 2 emissions towards kind of better quality of data disclosures, better comparability of data, but for scope 3, it's still a bit of a fragmented landscape out there in terms of what companies disclose, how they monitor and measure. So it really presents a lot of challenges of comparing like for like and benchmarking performance within a sector, for example. So I think technology can play a key role there, but I think standardization of reporting is really the critical thing.
Peter Gabor, do you have anything to add to that?
Well, on Pablo's question, yes, I thought it was very well formulated, and it's very much in line with our experience in that working on climate risk with financial institutions introduces another level of complexity. And the reason I say that is that structure business and our real sector business a couple of years ago, and the added, I guess, wrinkles, complexity of doing it with a financial institution is that the FI has a portfolio across dozens, if not 100 different sectors. So the complexity of that versus, say, financing a cement plant in our real sector business, you have one entity, you have one thing to look at, and then you turn to a financial institution and you have 50 different targeted asset classes. So definitely it's more complex, and I think the way to get your handle on that is first to target one or two of those asset classes to start with, and develop that with the bank and in conjunction with the senior management, having that strategic buy-in, and then also certainly having things risk weighted. So we are looking at some agribusiness portfolios and what is their risk or exposure to physical risk. So really you have to use a geomapping tool to see, okay, we're not going to look at the whole portfolio in the same level of complexity, but rather tailor it to where are the more vulnerable geographical areas of the portfolio. So I think that the question was right on.
Gabor?
Yeah, maybe just a short comment on the supply chain element. Again, I think it's also very important because of the SME part, who we are always missing from, for instance, ESG reporting, non-financial reporting, ESG ratings. Very often they are not covered by all these regimes. Just to mention one new legislative development in the EU, there is an ongoing new legal proposal. It's called the Corporate Sustainable Governance Directive, which will again apply just especially to large firms, but they will be required as part of having a proper corporate governance structure, which is embracing sustainability, to have a view and basically to look through the whole supply chain, exercising due diligence and all these things. And through large companies, we can all this can trickle down to SMEs. So I think it's again a very good initiative, how we can in a cost-effective manner cover also SMEs, and this of course can also help sustainable finance, which again is easier done because of the data availability first through large companies.
Yeah, absolutely. We've had another question from Patrick Flynn, who says, in terms of getting standardized frameworks up and running, the SDGs seem to be a good starting point to work back from. Is there a wide adoption of targeting the SDGs? And if not, why not? Rick, would you like to take this?
Thank you. I think in Europe, there's an increasing number of end investors who are interested in measuring SDG impact within their portfolio. But there is a very limited set of data to actually satisfy that need. There are certainly some asset managers who are ahead of the curve in this area and estimating or computing their own data. But again, it comes back to the underlying question, which is if the issuers themselves aren't able to deliver the data required or don't do it as a matter of course, quite hard for the intermediaries, whether they're banks or asset managers, to do so. But I think Patrick's, on the money in the sense that SDGs are, classical way of helping us understand the negative externalities or the externalities, and they're also widely accepted and endorsed, so they should be taken into consideration. They do cover a quite wide range of things where the financial sector has either limited traction or limited knowledge, or certainly limited traction in their own capacity without policymaker intervention as well. So maybe you need to boil down, as we have at State Street, think about SDGs that you really may be able to have an influence and are relevant to you from a stakeholder perspective, and then move ahead. But I think there's a lack of data there. I know that there's some asset owners that are doing work on that area in the Netherlands and Australia, the kind of combination of them trying to solve that problem.
Do any of our other panelists have thoughts on this question, reactions to what Rick's just said? David?
Yeah, I mean, I think, as Rick was saying, there's some practical challenges for many of the SDGs. These were created as public policy goals rather than sustainability objectives. So there are challenges in attributing impact, in particular, to specific SDG indicators. That being said, I mean, certainly on the environmental pillars of the SDGs, a lot of these are fairly clearly defined, and using existing data and frameworks, you can attribute impact quite easily there. I'd say when you get into the social and governance related pillars, the SDGs, it becomes a bit more challenging. But I mean, there's a lot of work going on, certainly in the asset owner community, to try and apportion impact there and to understand and measure impact against the SDGs.
Yeah, absolutely. We've had another question from Angel Gaviero, which is going back to the green bond discussion. So she says, regarding green bonds, it looks like the pricing incentives baked in, for example, 25 BP's haircut if KPIs are met, are arbitrary, meaning they are not calibrated with the financial impact. So, for example, operational costs incurred to achieve the KPI. So her question is, could this actually de-incentivize achieving the KPI? What are our thoughts? David, do you have a reaction to this?
Yeah, I mean, I guess on the green and stability linked bonds side of things, I mean, the view they typically take is that just by virtue of issuing a green and stability linked bond, you are opening yourself up to increased investor scrutiny of your overarching strategy, particularly around climate risks. So we do see increasingly kind of investor engagement kind of moving into areas of climate governance, for example, management strategy, short, medium, long-term goals, and where this issuance would fit within that. So I think I take the point around the basis points versus the kind of cost of mobilizing resources to this, but I think by virtue of issuing these forms of debt, you are opening yourself up to more scrutiny, and I think will increasingly lead to kind of push for better data and better disclosure in some of these areas. You see organizations such as Net Zero Asset Owners Alliance kind of pushing for better data around the kind of qualitative aspects of climate governance and integration into management strategies. So I think that can be a key driver there.
Yeah, absolutely. Gabor, do you have a reaction to that and answer to this question?
Yeah, maybe just two thoughts here. I confirm that sustainability linked bonds are tricky. So as a regulator, we've also been approached by industry players that we should, as a central bank, for instance, provide guidelines about what are the meaningful KPIs, what kinds of incentives should be incorporated in these sustainability bond frameworks. And we said, well, it's really very tricky. And of course, currently, as there is no, let's say, official regulation for such instruments, there's a big responsibility for the second party opinion provider, so the external assurance provider, who one of these firms' task is to make sure that, for instance, the KPIs are meaningful. So it's, but again, it might sound like a cliche, but it's really a very delicate issue. But I agree that the economics of such instruments, I think it's very good. So I think it's very promising that these instruments have started to emerge, and actually this market is growing very fast. Well, not in Hungary yet, but I think globally. So let's just make sure that the frameworks are proper. And this is, of course, just about sustainable linked bond, when there is basically a link between the yield of the bond and basically the performance of the bond issuer. But let's not forget that green bonds also have, I think, some still delicate issues, like the problems with green defaults. Fortunately, I think we haven't really seen too many green defaults, well, not in Hungary yet, but it's still a very young market. And let's not forget that also the treatment of green defaults is, I think, largely unregulated. Hopefully there won't be many green defaults globally, but this might also be something that we have to take care of also as regulators.
Yeah. Sorry, please, Peter.
Sorry, maybe I'll just add that we're seeing great interest in sustainability-linked products in emerging markets. And I'm sure we've also recently seen some greenwashing or KPI kind of claims that they don't go far enough in terms of what is the KPI. So I really liked Gabor's point about relying on that, the verification agent to, one, is confirm that it's been met, and also at the beginning, the outset, that it's actually a really genuine, legitimate KPI that's either related to reducing GHG emissions or improving climate resilience. I think that those are key points.
Yeah, right. I'm conscious of the time, so I just want to bring it back to scenario analysis, which we touched on at the beginning of the discussion, which David mentioned. So obviously scenario analysis tools are taking a key role in kind of how firms and economies are understanding their exposure to physical risks and the impacts of that on kind of different transition pathways. So my question is, what strategies should financial institutions have in integrating scenario analysis into climate risk? And Gabor, maybe I can go to you again as our central banker to begin with that, answering that question.
Yeah, I mean, maybe just some high-level points also from our experience. We've just recently finished our first climate stress test as a supervisor. It's really a beginning exercise. So again, we wouldn't claim that we already have the crystal ball. I think it's a very complex topic. So just maybe some lessons that we've learned, also what we've seen about the Hungarian banking sector. So first of all, I think we already see that both short-term climate stress test and long-term climate stress test make sense. Both have their own objectives. We've run a long-term climate stress tests initially, but we are already preparing short-term climate stress tests, which will basically use, for instance, other kinds of scenarios like short-term shocks. We can now take a look at what is happening on the energy markets, just to mention one example where I think we are seeing, unfortunately, some interesting shocks which could serve as inspiration for short-term climate stress testing. Just a few more lessons what we've seen. So first of all, in Hungary, actually it's looks that transition risks are of course there, but altogether for the macroeconomy as a whole, and also on the banking sector's performance, a successful transition would be good news. So in all climate stress tests, the NPL ratios and I would say excess NPLs are basically modeled, and we are seeing that if there is an early and smooth transition of the economy, then that would be good news for the financial stability, and actually this would result in lower NPLs, so non-performing loans. Of course, with physical risks, there is a much unfavorable message. If climate change is not mitigated, then that has, of course, obviously detrimental GDP effects, and through the macroeconomy. Also, our climate stress test shows growth in NPL ratios. But again, modeling non-performing loans until 2050 is extremely uncertain kind of modeling. But still, it's informing discussions with banks. So it's something which we can discuss with them, like bank by bank, the results. And just to mention one more final thing, what we see also across sectors, there are very, very diverse impacts. So altogether, for instance, this excess NPL ratio for the whole banking sector is not really extremely huge, but there are very large differences across sectors. So obviously, there are some sectors who can gain from transition, who are not that exposed to physical risk, and there are other sectors which have other characteristics. And altogether, the aggregate impact for the banking sector might not be that huge in a climate stress test, but there could be much stronger implications for certain industries. So that's again one lesson that we learned from our first climate stress test.
David, do you have anything to add to that?
Yeah, I mean, I think just going to Gabor's point as well, it's interesting to note a lot of regulators are talking about scenario analyses rather than climate stress tests. I think this highlights the fact, we have a bit more flexibility here in the methodologies, how these are applied in comparison to conventional kind of bank stress testing. And we're also going to learning a lot as central banks and regulators kind of go through these processes. So, for example, you've seen the example of the ECB climate stress test. They've actually adopted a methodology where they're bringing forward 2030 carbon price increases in a more rapid transition scenario to 2022-24. So they're front loading a lot of these impacts to look at, based on lending in the here and now, where would these impacts materialize? And that's accounting for the fact that, projecting kind of loan exposures, lending exposures out to 30, 40 years is inherently extremely uncertain. So if we can look at the near-term risks, we can look at the near-term kind of disorderly or orderly transition risks, and that can actually be a lot more informative. And I think, just going back to the points that we talked about previously as well, just relating these transition risks to the typical CapEx and OpEx cycles of different industries is pretty critical. Thinking of the steel industry in particular, we've actually seen a very rapid increase in the European emissions trading scheme carbon price in the last 2 to 3 years. That has been much more rapid than I think a lot of those industries had necessarily anticipated. So we're seeing energy intensive industries really kind of feeling that in terms of compliance impact there. And again, the CapEx and OpEx cycles for those industries are typically so long that actually kind of bringing production, bringing kind of investment in line with these tighter regulations is quite a challenge from that perspective. So these are the sort of things that that stress tests can be useful to kind of prize out the near-term impacts. I think the Canadian climate stress test that was recently undertaken was also really helpful in terms of looking at impacts on the real economy. So that looked at a decline in commodity prices, particularly oil and gas, which is obviously around 10% of the Canadian economy. And it looked at 5 to 15% of participating bank and insurance sheets, and it found that oil and gas, crops, and livestock industries actually had the biggest increase in probability of default due to sector emissions and carbon prices. And I think going to some of the other examples out there, I mean, we can compare and contrast what the Bank of England is doing and the Bank of France. So the French ACPR obviously took a dynamic balance sheet approach when it was looking at the stress tests and assuming investment or divestment from different sectors and different activities occurs over time. And again, this can capture the kind of dynamic aspects of this risk over time. The fact that certain industries will inevitably be more impacted than others, that investors will over time and lenders will respond to this over time. And I think the other final point I'd make is the interplay of the transitional and physical climate risks. So I think clearly most stress tests that are being conducted, the majority are looking at both an orderly and disorderly transition scenario, assuming a delayed transition leads to worsened physical climate risks. I think some of the science behind the IPCC is making clear that the window for an orderly transition is narrowing very quickly. The longer that countries delay climate action, the more disorderly this transition will be. But clearly there is an interaction between the transition risks and the physical risks. So one example that comes to mind there, going back to the example of real estate and EPCs, is, we know in many regions such as Europe and the UK that there's going to be tightening energy efficiency standards in buildings. So then banks are naturally kind of looking towards the more energy efficient certified buildings. In the example of the UK, actually a lot of those buildings are located in areas that are at heightened flood risk over longer timescales. So again, it's about the risk appetite over time, about how much of this risk you're willing to accept in the short, medium, and long term. And these are some of the learning points that climate stress tests can unfold. But I think the point that we made in our paper that went out last week was that increasingly regulators are going to be using these exercises not necessarily to look at the quantitative outcomes in terms of probability default or exposures, but more to understand within regulated banks and insurers their internal capacities to understand these risks, their governance structures to manage these, and the risk management structures. So there is quite a strong qualitative aspect to it as well, I'd say.
Yeah. Rick, do you have anything to add to that?
Yes, I think the paradox with both stress testing and climate scenario analysis is that we expect and understand that it's vital that we do it. It's a vital tool, but it's unlike the way the tools have been used before, because when we think about stress tests and scenario analysis, we have a parametric approach very often, or a historical approach. That's a great comfort. You understand the relationship between the financial variables and some of the things that you're stressing. In this case, it's a little bit more difficult to do that. So it's vital that we do it, but we need to put not a set of parentheses around the result, but to be careful about how we interpret the results, because you're piling unknowns on unknowns. Particularly the question who actually pays the price, where there is a carbon price, to what extent is it passed on, how much is absorbed. Now there are historical and analytical methods in finance and economics to get at this. But it is a unique problem, and therefore one we haven't faced before. So I think we need to be careful about being too certain about the results, notwithstanding the fact that it's vital that we actually do it, so we can compare institution A with institution B, and particularly tease out some of the things that were mentioned about concentration risk, where that's a particular problem with physical risk, to a certain extent transition risk as well for a financial institution. So I'm encouraged by the work. And again, our clients have got a huge appetite for this and doing climate scenario analysis and stress testing. But for many of them, the question also is, how much is in the price? Now, that's not so much an issue that banks necessarily ask themselves, but certainly for large-scale asset owners, how much is already in the price? Because it's not as if markets have been asleep at this issue and don't understand that we're going to have quite significant changes. But understanding how much is in there already is quite difficult, to say the least of it.
Yeah, I think that's an excellent point. We've had another question from Patrick Flynn, and it goes back to the data issue, which we've touched upon quite a few times in a discussion today. So Patrick is asking, are we approaching, or is there already a market where issuers of proven data quality and transparency are becoming oversubscribed when they come to the market? And is this desirable to achieve a better market behavior in terms of getting that data? Rick, do you have an answer to this?
I don't have an answer in terms of a list of issuers, but I'd fully expect that to be the case. I mean, anyone with a track record on any dimension as an issuer will make a difference in terms of the premium or discount that they're wearing. And it does tell you something about management quality. I mean, a lot of discussions about data quality and transparency, but it's really about management quality at the very top level, and how an institution is governed and how that flows all the way down the organization. Mm-hmm. So I think it's telling you something about the organization that investors have a track record of being willing to pay for.
Yeah. Peter.
Maybe I would just add that it also brings the point of the importance of capital markets and financing the transition. So we work in the financial sector primarily with banks, but the reality is that even if banks increase the proportion of their balance sheet that is invested in climate-related investments to 20%, there's still at least half of the, they're only at 50% of the needed financing, at least in emerging markets, to finance a transition. So it's critically important that capital markets come in and play a role, and that we have a whole suite of products that an investor can access. So green bond, blue bond, sustainability linked, now transition bonds. So I think it underscores the importance of that it's not just a bank financial sector solution for financing transition, but rather it's a broader capital market issue. And one other point I'd like to make is that when we look at development finance institutions, like we may think we have a lot of money and can do a lot of things collectively, but if you compare our assets to the total institutional investor universe, it's 900 to 1. Okay, so for every dollar we have as DFIs, they have 900. So really, the true value add that we can bring is taking some of that 900 into emerging markets to finance a transition. And the best way to do that is through capital markets. And by creating the taxonomies, the infrastructure, the capital markets that will allow either domestic or cross-border investors to come in. And underpinning that is you need to have confidence in an investor, as an investor, that this is actually a genuine, legitimate, verifiable product. And if they say it's a green bond, that truly it is. If they say that there's a KPI, that really it is an ambitious one. So I think it underscores the importance of the whole data quality and transparency issue. Thank you.
Yeah, absolutely. David Gabor, do you have anything to add to this?
Yeah, I mean, I guess just to reiterate the point that, just providing kind of good high quality disclosures, for example, a KPI linked bond or sustainability linked bond, it is a mark of, that level of additional engagement, both within the management of the organization. So multiple levels, procurement, corporate treasury, etc., C-suite on these topics, but also usually it can entail kind of engagement with customer bases, engagement with suppliers. So it's really kind of companies opening themselves up to engagement on these issues in ways that maybe are less familiar. So I think that kind of clamor for better information, better disclosure, really can kind of drive up quality of disclosure longer term. And I think the better information clearly is what is going to underpin improved performance in terms of emissions and climate risk longer term. But yeah, it's clearly something where standardization can play a key part. We are part of quite a few of the ICMA working groups on transition finance, for example, so trying to improve kind of quality and comparability of disclosures there. We do know a lot of the development finance institutions played a key role in the green bond market in terms of driving up standards for disclosure. And really, I think there's kind of a clamor more and more for better quality of information, more forward-looking data in particular, but more of those kind of governance-related aspects that I mentioned around kind of management ownership of these topics. So I think that will hopefully be a virtuous cycle of better information and better performance longer term. Yeah.
We're running out of time. So one final question to you, David, and then I'll ask you to say your final remarks. Do you think there is enough impactful green assets for financial firms to invest in? And will regulatory pressure be enough to encourage the development of more green assets?
Yeah, I mean, I think clearly there's challenges inherent to measuring what is a green asset versus, what is a brown asset, or something that's negative from a climate perspective. I think it's something that regulators have talked about quite a lot in recent years in the context of prudential regulation and whether we want to incentivize green assets versus penalizing brown assets. That obviously opens up a lot more kind of wider issues around, how do we measure what's green? Does incentivizing investment in those assets potentially impact on financial stability longer term because of the lack of confidence in what is a green versus what is a brown asset? And we're all aware, there's still huge amounts of greenwashing going on in certain areas of the market with assets that are labeled as green but maybe don't kind of have the credentials to back that. So I think in general, from a financial regulation point of view, penalizing brown certainly seems a lot closer to orthodoxy than incentivizing green. And I think regulatory policy, prudential policy, it can't really address the underlying cause climate risk. So fossil fuel assets, continued emissions, these are systemic in nature within the wider economy. So they're not a substitute for public policy. It's really got to come from regulation and public policy rather than, banking regulation per se.
Yeah, brilliant. Thank you. Brick, same question and final remarks.
Sure, I think it's absolutely right that regulators are focusing on the prudential aspects of climate change and also the consumer protection elements of greenwashing, as we say. I think when it comes to directing capital, I'd be less convinced that that's an appropriate role for regulators. Certainly, it could be an appropriate role for policymakers to think, how do I direct capital overall? But executing it through in that way maybe muddies the water quite considerably and brings risks that we don't yet see. So I think I'd be a little more cautious about that sort of triple mandate, if I could put it that way.
Yeah, absolutely. Peter, same question and final remarks.
Great. Thank you, Emma. I mean, I'll just close by saying that, this climate risk topic is vitally important, particularly in emerging markets. But what is also, in a way, potentially more important is the climate investment opportunity. So they both go hand in hand. And really, what I think we as market participants, regulators, we need to create, provide the financing, but also provide the frameworks and the ability for these markets to develop new instruments and also implement climate risk assessment so that there's a full understanding of the transition risk and the physical risk. So, and I'd also just like thank UMFIF for hosting this really timely and important topic.
Thank you, Peter. Thank you. And Kabul, final remarks from you?
Just very shortly, the question mentioned regulatory pressure. I would rather use like a more nicer word like regulatory incentives and encouragement. And actually, our experience tells us that regulatory encouragement is helpful. So we've, as a central bank, introduced a number of regulatory incentives, and they have been helpful also to jumpstart the market. And let's mention here that Hungary is a less developed financial market, and we've experienced that these instruments really help to jumpstart the market. So we've seen the starting of the green corporate bond market and also the green covered bond market issued by Hungarian banks. So yeah, I think regulatory incentives, especially with less developed markets, are very important to jumpstart green finance markets.
Yeah. Lovely. Thank you so much. Look, thank you to all my panelists for joining today. Thank you to our audience and our audience questions. We were going to discuss nature-related risks slightly today. We ran out of time, but this is a topic that UMFIF will be looking at more and more. We are looking at biodiversity metrics and things like that. So I hope this is a conversation that we can continue. And I think it warrants a panel all on its own anyway, looking at nature-related risks. So thank you to everyone for joining. I hope to see you again and have a lovely afternoon.